All right, CMA candidates, let's get right into it. Welcome to this explainer where we are going to completely master the exact boundaries between financial, cost, and management accounting. Look, if you're gearing up for your written exam, you already know these concepts overlap just enough to be incredibly frustrating. But stick with me, because by the end of this session, you're going to be breezing through those comparative questions with absolute confidence.
So think about this for a second. Can you define the exact boundary between cost and management accounting right now? This is a classic trap on the exam. It's so easy to blur the lines between the two because, well, they both serve internal management. But don't stress. By the time we wrap up this explainer, you are going to have the perfect test-ready answer locked away in your memory. Here is our game plan for today. We're covering the 3 accounting pillars, followed by some head-to-head matchups: financial versus cost versus management, and financial versus management. And finally, we'll wrap it all up with your key exam takeaways. Okay, Section 1, the 3 accounting pillars. Let's start with the absolute basics. Building a really strong foundation right now is what prevents all that concept bleeding when we get to the complex stuff later. Every single accounting system you'll study is built on these 3 chronological steps. First up, we have documentation. This means having standard forms and policies with built-in controls to ensure assets are used exactly as intended. Second is tracking. This is the heavy lifting, honestly. It occupies the bulk of an accountant's time as they collect information on every specific business transaction. And third is financial reporting. This is where all that tracked data gets aggregated into specific frameworks: your income statement, balance sheet, statement of cash flows, and those supporting disclosures. Now, when we talk about financial accounting, the ultimate target audience is absolutely key. This is the systematic procedure of recording transactions primarily to reveal the overall profit or loss to external stakeholders. Because it provides a true and fair evaluation of the business, it's ultimately there to safeguard the interests of those outsiders. We're talking investors, creditors, and government regulators. On the flip side of that, we have cost accounting. Now, technically, this is a subset of financial accounting, but it shifts the spotlight entirely inward. It focuses heavily on the cost accumulation process, essentially figuring out exactly how raw materials are converted into finished goods. Its main goals: to control operations, maximize efficiency, and determine production costs to serve the internal needs of the organization. And finally, we have management accounting. This one is fundamentally about assisting management in planning and decision-making, which is exactly why you'll sometimes hear it called decision accounting. Think of it as a much broader umbrella. It takes financial data, mixes it with non-financial information, and uses the whole package to forecast alternative business actions and guide day-to-day strategy. Moving right along to Section 2, financial versus cost accounting. Let's get into our first head-to-head matchup. The core divergence between these two systems really comes down to how you look at the business itself. Think of it like this. Financial accounting is about reporting on the whole pie. Cost accounting, it's about slicing that pie up objectively to help management plan and control operations. Notice the difference in recording here too. Financial is classified subjectively by transaction type, like salaries or rent. Cost, however, is classified objectively by functions, products, or specific processes. Now, here is a key differentiator you absolutely need to memorize: statutory obligation versus voluntary operational utility. Financial accounts are legally mandatory. You have no choice. You have to follow the Companies Act and Income Tax Act. Cost accounting? That's maintained voluntarily, purely because internal management finds it useful for running the show. All right, pop quiz time. Let's test those reflexes. If you see a question on the CMA exam asking, which accounting system reveals the relative efficiency of specific plant machinery, you need to instantly know which conceptual framework to pull from. Got your answer? The answer is cost accounting, and here's exactly why. Financial accounts look at the macro evaluation. They look at the whole forest. They simply cannot reveal the relative efficiency of individual departments. Cost accounting is your micro evaluation. It gives you the specific data required to inspect the health of the individual trees, showing you profit per product, per job, and yes, the exact relative efficiency of that specific plant machinery. Okay, Section 3. Cost versus management accounting. This is honestly the trickiest boundary to define, so pay close attention. The crucial dividing line here is the actual type of information being used. Cost accounting deals strictly with quantitative data, the hard, cold numbers of production. Management accounting, on the other hand, takes that hard data and blends it with qualitative, non-financial insights. So while cost aims to ascertain the exact cost of production, Management aims to use that information to forecast and choose among alternative business strategies. Here's another massive distinction you'll want for the exam: structural dependency. Cost accounting uses very specific procedures, and interestingly, it can actually be installed completely independently without management accounting even existing in the company. Management accounting is the exact opposite. It has no specific procedures, its scope is extremely broad, and it literally cannot be installed without cost accounting. It relies entirely on the structured data first generated by the cost and financial systems. Let's hit another quick mock question. Does management accounting primarily focus on historical data analysis? Take a second. Lock in your answer based on what we just discussed about forecasting strategies. If you said no, you nailed it. The time horizon is a huge dividing line. Cost accounting targets the recording of past and present cost data. Management accounting takes that historical data and uses it as a lens to peer into the future. It places its major stress on analyzing future projections and alternative business actions. It is fundamentally futuristic in its whole approach. Let's tackle our final comparison in Section 4, financial versus management accounting, the furthest ends of the spectrum. This is where you really see how radically different these systems are. Financial accounting's role is strictly limited to finding out the ultimate result, that true and fair picture of profit and loss, strictly in monetary terms. Management accounting, it goes a massive step further. Basically, it begins where financial accounting ends. It has a much broader scope that digs into the cause and effect relationships behind those financial numbers, so that management can actually take meaningful, strategic steps forward. And finally, Section 5, key CMA exam takeaways. We have covered a lot of ground today, so let's distill all of this into the ultimate cheat sheet for your written exam. I want you to burn these specific anchor words into your brain right now. When you see external on a question, think financial. Internal, that's cost or management. If a prompt asks about qualitative data or futuristic projections, boom, you immediately know it's management accounting. If it asks about statutory requirements, financial. Seriously, if you master these specific trigger words, you are going to confidently navigate any comparative scenario question they throw your way. Ultimately, what this all boils down to is that these aren't just isolated silos you're forced to memorize. They're beautifully complementary tools. By understanding how financial accounting lays the monetary groundwork, how cost accounting details the micro-efficiency, and how management accounting steers the future strategy, you're proving you possess the 360-degree analytical mindset that is expected of a certified management accountant. So I'm going to leave you with this to chew on. As a future CMA, how will you leverage all three of these distinct systems together to ensure an unbeatable 360-degree evaluation of your organization's true performance? Keep that strategic question in the back of your mind as you continue your studies.
So we're going to build a rock-solid foundation today. We'll break down the exact definitions and core concepts you need to know straight from the source material, so you can walk into that exam feeling absolutely confident. Let's get started.
So why did we even invent cost accounting? Well, picture the absolute chaos of the factory system during the Industrial Revolution. Before we had massive factories, traditional financial accounting was totally fine. But once complex manufacturing kicked into gear, management suddenly needed a totally new way to figure out and actually control their costs. Financial accounting just focuses on past data, so it couldn't give them the detailed, forward-looking information they needed to plan ahead. Out of that sheer necessity, cost accounting was born. Over time, this necessity evolved into a highly structured profession. In India, for example, serious cost consciousness really took shape during World War II, when the government had to verify cost structures for defense contracts. This actually led to the Institute of Cost and Works Accountants of India being established in 1944 as a registered company. Fast forward to 1959, an Act of Parliament converted it into a statutory body. And then finally, in 2012, it got its current name, the Institute of Cost Accountants of India, or ICAI.
Here is our roadmap for today. We'll quickly cover why cost accounting exists, jump into core concepts, tackle direct costs and overheads, explore cost behaviors, and wrap up with the cost accounting standards.
Okay, Part 1. Why cost accounting exists. The crucial takeaway here is the focus. Think of financial accounting like looking in the rearview mirror. It records what has already happened, the legacy of the business. Cost accounting, though, that's your windshield. It's a dynamic tool focused entirely on future decision-making and efficiency. Traditional accounting just cannot give the internal organs of a business the analytical data they desperately need. Cost accounting steps in to accumulate those costs, tie them to specific products, and create a real management information system for profit planning.
Moving right along to Part 2, Core Concepts and Definitions. Get your mental flashcards ready. You absolutely need to remember this duality for the exam. The CMA official terminology tells us that cost is not just a noun, meaning the actual cash paid to acquire an asset. It's also a verb. It's the action of ascertaining the cost of a specific activity. It's how we measure the resources we sacrifice to hit a target. For instance, the quote-unquote cost of making a single cup of tea is the exact amount incurred on the materials, the labor, and the overhead. Whether you're brewing tea or running a bank, calculating the cost means figuring out exactly what resources were used for that specific objective.
Now, if you are measuring a cost, you have to be measuring it for something, right? Well, that something is your cost object. And this is a really broad term. A cost object could literally be a physical product on an assembly line, a service you provide to a hotel guest, a specific sales region, or even just one single customer. It is simply any item that requires you to measure its cost. Once you've accumulated all those costs, how do you express them so they make sense? That's where the cost unit comes in. It's your essential measuring stick. It's a unit of a product or service that lets you break down total massive expenses into meaningful subdivisions. So we're talking about things like the cost per kilogram of raw material, the cost per meter of fabric, or the cost per liter.
Think of a cost center as a giant logical bucket where you gather up costs before you assign them to specific units. It might be a physical location, a piece of equipment, or a whole department function. These can be personal, meaning a specific person or group of people, or impersonal. Broadly speaking, they're usually split into production cost centers and service cost centers, which becomes incredibly important when we get into allocating overheads later on.
Which brings us perfectly to Part 3, direct costs and overheads.
It's fascinating how the basic elements of cost, materials, labor, and expenses, split so perfectly into two camps, traceable direct costs and those really tricky indirect overheads. Direct material, direct labor, and direct expenses can be traced straight to the product itself, but indirect materials, indirect labor, and indirect expenses, those all pool together to form your production, administrative, and selling overheads, and those require some very careful allocation.
Write this down for your exam formulas. Prime cost is the core. It represents your directly traceable expenditures. It's simply the sum total of all your direct costs. That's direct material plus direct employee cost plus direct expenses. That's the whole shebang for prime cost.
Conversion cost, on the flip side, is exactly what it sounds like. It's the effort, the labor, and the factory overheads required to actually convert that raw material into a finished good you can sell. The official Cost Accounting Standard 1 defines it quite simply. It's the production cost, excluding the cost of direct materials. All right, let's shift gears to Part 4, Decision-Making and Cost Behaviors. Understanding how costs behave when your production volume changes is an absolute game changer for managerial decisions. A fixed cost, often called a period cost, stays completely flat no matter how much you produce within a certain range. Think of your factory rent. A variable cost, however, flexes with you. If you double your factory's output, your total variable cost is going to double right alongside it. Watch out for this classic exam trap. Never ever let a historical sunk cost influence your future choices. A sunk cost is money that's already spent, it's gone, it's irreversible, and it is entirely irrelevant to your decisions today. Differential cost, however, is highly relevant. It's the actual difference in total cost between two distinct alternatives you are facing right now. If picking an alternative makes your costs go up, it's an incremental cost. If it makes them go down, it's decremental. CMA candidates pay super close attention to this distinction. Estimated costs are basically anticipating the future based on past averages. They inherently include anticipated wastes and inefficiencies. Standard costs? Totally different. They dictate what the future should cost if you are operating efficiently. They are rigorously planned out on a scientific basis. We use standard costs as a strict benchmark to compare against actual costs, which lets us perform variance analysis and spot inefficiencies instantly. Then we have marginal cost. By isolating the variable cost of just one single extra unit, management gets a razor-sharp tool for short-term pricing. Let's say producing 800 units costs you $12,000 flat. But producing 801 units costs $12,010, while your marginal cost is exactly $10. It's the change in your aggregate costs caused by a one-unit change in your production volume.
And finally, Part 5, the Cost Accounting Standards, the official rule book.
Established in 2001 by the ICAI, the Cost Accounting Standards Board created these standards for one major reason: to end the Wild West of arbitrary cost allocations. Their main objective is to bring uniformity and consistency across the entire industry. By giving us a structured, harmonized approach to measuring costs, these standards ensure regulatory compliance and let management make decisions based on rock-solid, comparable data.
There are 24 total standards issued, but you absolutely need to know these specific numbers and titles cold for test day. For example, CAS 1 is all about the classification of cost. CAS 6 dictates material cost. CAS 13 governs the cost of a service cost center. And CAS 14, that one deals specifically with pollution control cost. Memorize these mappings for sure.
This ICAI mission statement is a fantastic reminder that memorizing these terms isn't just about passing a test. It's actually about ethically driving global enterprise value. True professional conduct means maintaining total independence of thought and action, so your future cost reports are always objective, unbiased, and genuinely valuable to your stakeholders.
So I'll leave you with this provocative thought to ponder as you hit the books. As business environments get wildly more complex, how will these cost accounting standards have to evolve to capture the invisible costs of our digital age? The fundamental principles of tracking resources will always remain, but the application is constantly shifting.
Today, we are taking those essential cost accounting classifications and transforming them into your ultimate visual exam blueprint. We're going to break down these crucial concepts, making absolutely sure you don't just memorize the definitions, but you truly understand how to apply them. But before we get bogged down in heavy textbook definitions, I wanted to think about something. What is the true cost of taking a 1-hour nap? It sounds like a total trick question, right? But the answer to this really relatable everyday scenario actually holds the secret to understanding the single most critical concept in management accounting. So just keep that in the back of your mind for a minute. All right, here's our quick roadmap for today. We'll be covering the definition of cost, costs for decision-making, managing and controlling costs, defining cost objects, and finally, defining cost units. Let's get right into it. Starting off with Section 1, the definition of cost, the foundation of measurement. So Cost Accounting Standard 1 officially states that cost is a measurement, in monetary terms, of the amount of resources used for the purpose of production of goods or rendering services. Now, for your exam, you've got to laser focus on that phrase, monetary terms. We are quite literally taking sacrificed resources and quantifying them into currency. Under that big umbrella definition, costs generally split into two main camps. First up is historical cost. This is purely factual. It encompasses the actual expenditures made in the past to produce output. Think direct material costs, direct labor costs, and manufacturing overheads. Second, we have economic cost, which you probably know better as opportunity cost. This represents opportunities forgone. It's the value of the absolutely best alternative course of action that you did not choose. And that brings us right back to our nap example. Imagine you have a job offer that pays $25 for an hour's work. If you choose to say, hey, I'm going to take a nap instead, well, the historical cost of that nap is $0. You didn't actually dish out any cash to fall asleep. But the economic cost, that is a very real $25. That's the exact benefit you forewent by deciding to sleep instead of working. Okay, moving on to Section 2, costs for decision-making, the manager's arsenal. When you're sitting down to actually make a choice, only relevant costs matter. These are costs that are pertinent to the specific decision at hand. Because we only care about expected future costs that differ between our options, historical costs are generally totally irrelevant to the decision-making process, unless, of course, they remain unchanged in the future period. Which leads us straight into the ultimate exam trap, the sunk cost. A sunk cost is a cost that has already been irreversibly incurred or committed. Because you cannot recover it or change it by any future action, it absolutely cannot be considered relevant to a decision. These are also termed irrecoverable costs. Guys, when you spot one of these on a test question, completely ignore it. Next, let's contrast out-of-pocket costs with imputed costs. Out-of-pocket costs are exactly what they sound like, actual expenditures or tangible payments made by a business for goods, services, or resources. It's real cash leaving your hands, like direct payments for wages. Imputed costs, on the flip side, are hypothetical or notional costs. They don't involve any cash outlay at all, but they're computed strictly for the purpose of decision-making, very similar to opportunity costs. Interest on internally generated funds is a classic example of an imputed cost. Section 3. Managing and controlling costs. Operational oversight. So, avoidable costs are those inefficiencies which, assuming you have good conditions of performance efficiency, simply should not have been incurred. Unavoidable costs, though, are completely inescapable. They essentially must be incurred within provided norms or under a program of business restriction. They're fixed in nature and you just can't get out of them. Building on that is the crucial concept of controllability. A controllable cost is subject to direct control at some level of managerial supervision. Conversely, a non-controllable cost is not subject to control at any level of managerial supervision. You've really got to know this distinction if you want to properly hold teams accountable for variances. Section 4. Defining cost objects. Targets of measurement. Put simply, a cost object is literally any item for which cost measurement is required. GAMC and CMA officially defined it as an activity, contract, cost center, customer, process, product, project, service, or any other object for which costs are ascertained. You definitely need to recognize these exact phrases for your exam. To ground all that theory in reality, consider these quick examples. A manufactured product? That's a cost object. A service rendered to a hotel guest? Also a cost object. Even an entire sales territory can be one. Basically, if management needs to measure it, it's a cost object. And finally, Section 5, defining cost units, breaking down the costs. A cost unit is basically a device we use for breaking up or separating costs into smaller, manageable subdivisions attributable to our products or services. GATKeep defines it as a form of measurement of volume of production of a product or a service. A really important thing to note here is that the specific cost unit a business uses is generally adopted purely on the basis of convenience and practice in the industry concerned. Here is how this all builds into a practical hierarchy. Step 1. You trace your costs down to the cost center. Step 2, you further analyze those accumulated costs to establish the exact cost per cost unit. However, keep in mind that some items, like your direct materials and direct labor costs, might just be charged directly to a cost unit. Wow, we have covered some incredible ground today, from the baseline CAS-1 definitions all the way down to calculating cost units. So I'm going to leave you with this final thought as you head back to your exam prep. When you're facing your next big management decision, whether that's on a multiple choice test or out in the real world, will you be trapped by sunk costs or will you be guided by relevant economic costs?
Cost measurement and managerial accountability. We're going to decode the specific terminology that CMA and GA-GAAP use, and we'll take it step by step so it actually sticks. I am seriously excited to guide you through this because mastering these building blocks, it's literally the secret to unlocking those top-tier scores. Right off the bat, I want to hit you with a classic exam dilemma. It's pretty easy to figure out the cost of a physical thing, right? Like a chair or a car. But how on earth do you accurately measure the cost of an intangible service? And, maybe more importantly, once you figure that out, who exactly within the organization is held accountable for that cost? Well, that is the exact problem we're solving in today's explainer. Okay, let's dive into this. Here's our quick roadmap for the session. 1. The composite cost unit. 2. Cost centers explained. 3. Understanding responsibility centers. 4. 4 types of accountability. And finally, 5. Final CMA exam review.
All right, Section 1. The composite cost unit, measuring the intangible. Let's get into it.
So, when an organization's output is a service instead of a tangible good, finding a practical way to measure that cost gets kind of tricky. Because services are intangible, their cost units usually need 2 parts just to make sure you're doing valid cost comparisons. We call this the composite cost unit. Think about a freight delivery service. If management only measured the cost per ton delivered, that wouldn't actually be an appropriate unit. Why? Well, because it simply isn't valid to compare the cost per ton delivered from place A to B with the cost delivered from place M to N. Distance is a massive factor. I mean, delivering 1 ton over a single kilometer is vastly different than dragging it over 10 kilometers. So we need a composite unit that captures the whole shebang, both weight and distance.
And this brilliantly illustrates how different businesses actually apply this in the real world. Over in a hospital setting, your composite cost unit is the patient day. That combines the individual patient with the actual duration of their stay. For freight transport, like we just talked about, it's the ton kilometer. And for passenger transport, think buses or airlines, it's the passenger kilometer. You've really got to visualize this 2-part structure because, trust me, it is a prime target for those multiple choice questions on your exam. Understanding this proves you get why composite units are absolutely crucial for improving cost control in service organizations.
Moving right along to Section 2, cost centers, where costs accumulate.
Let's look closely at the official CMA terminology here. They define a cost center as a production or service location, function, activity, or even an item of equipment for which costs are accumulated. And GACAP echoes this pretty closely, calling it any unit of an entity selected with the view to accumulating all costs under that unit. The easiest way to think about it, a cost center is simply a logical subunit. It's like a giant collection bucket for costs before we dive in and analyze them further. Oh, and for accounting purposes, standard departments are usually termed cost centers.
Now pay really close attention to this distinction, because candidates fall for trick questions on this all the time. Cost centers are basically split into two types, personal and impersonal. A personal cost center consists of, well, a person or group of persons. Makes sense, right? On the flip side, an impersonal cost center consists of non-personal items, like a specific group of plant machinery or equipment. So remember, a cost center doesn't necessarily have to be a room full of people. It can absolutely just be a standalone function or a machine.
Okay, we can also divide cost centers into two broad functional types: production and service. Production cost centers are the ones directly engaged in making the product. We're talking the machine shop, the welding shop, or the main assembly line. Service cost centers, on the other hand, exist purely to render support to those production centers. Think of the powerhouse, general maintenance, the stores, or the purchasing office. They're incredibly vital for sure, but they play an auxiliary supporting role.
Up next, Section 3, Responsibility Centers, the Human Element.
According to CMA, a responsibility center is a departmental or organizational function whose performance is the direct responsibility of a specific manager. So the crucial point is that this refers to a specific segment of the company where one particular manager is given the authority and held accountable for business goals. It's an entity with its very own policies and procedures, giving a manager specific responsibility over things like revenues, expenses, and invested funds. See what we did there? We just moved from the micro level of where costs collect to the human element of who is actually answering to the boss for them.
Which brings us to Section 4, 4 types of accountability.
These 4 types of responsibility centers basically act as a ladder of complexity. You've got the cost center, the revenue center, the profit center, and the investment center. Each rung on this ladder represents a totally different degree of managerial authority and a different way of evaluating performance. Let's drill down into the specifics so you have a clear mental map of each one before the exam.
First up on the ladder is the cost center. Here, the manager is held accountable only for the costs that are under their direct control. So the inputs are measured in money, but the outputs, the revenues, are completely excluded from the picture. Think of a human resources department or maybe a maintenance team. Because they only deal with costs, these are often referred to as expense centers. And to evaluate this manager, you simply compare the actual costs they racked up against what was budgeted.
Next, we have the revenue center. Now, this segment is devoted primarily to raising sales revenue, with absolutely no responsibility for the costs of the goods or services they're actually selling. A classic example would be a regional sales office. To see how a revenue center manager is doing, you just compare the actual revenue they pulled in with the budgeted revenue. Oh, and fun fact, this exact structure is used all the time in not-for-profit organizations.
Moving up that ladder of complexity, we arrive at the profit center. Now, what's really interesting about this slide is the dual accountability. The manager here is responsible for both the inputs, so the costs, and the outputs, meaning the revenues. This means the manager actually has the authority to make critical decisions affecting price and volume. Their whole goal is to maximize profit, and their performance is usually evaluated based on the pre-tax profit generated by their specific segment.
Finally, we reach the most comprehensive level of the whole shebang, the investment center. Here, the manager isn't just balancing costs and revenues to find a profit. Nope. CMA dictates they have additional responsibilities for capital investment and possibly even financing. They act almost like the CEO of their own mini-company, completely accountable for the returns on the capital funds invested in their group. Because they control these heavy-hitting capital assets, their performance is measured using a very specific and ultimate metric, return on investment, or ROI.
Okay, go ahead and grab a screenshot of this master matrix right now. You absolutely need to lock in the distinctions between these 4 centers for the exam. You've got to memorize exactly what the manager controls in each, whether it's just expenses, just sales, both, or the whole lot plus investments. And you need to know the specific metric used to evaluate them. Being able to instantly recall this matrix, it's going to make you breathe right through those tricky responsibility accounting questions.
All right, let's move to our final section and see how this all builds together. Section 5, Final CMA Exam Review.
Let's hit the rapid-fire review. These are your biggest takeaways, the facts that are literally going to secure you points on exam day.
First, remember that services require composite units, like the ton-kilometer, because they need two parts to ensure your cost comparisons are actually valid. Second, cost centers are just the logical subunits, those buckets where costs accumulate before we analyze them. Third, responsibility centers bring in the human element, assigning specific managerial accountability. And lastly, when a manager controls capital, they are leading an investment center, and ROI is their ultimate performance measure.
Okay, I want to leave you with one final provocative question just to lock all this in. If a manager is evaluated on return on investment and they control capital assets, which responsibility center are they leading? Go ahead, say it out loud right now. Did you say investment center? Because if you did, you hit the nail on the head and you are well on your way to mastering this material.
You can't just sort of know the definitions. You really need to understand exactly how frameworks like CMA, GAAP, and the cost accounting standards classify and calculate costs. So today, we're going to visually map out these exact frameworks so you can lock them right into your memory. Let's get started.
Here's a quick look at our agenda for today. We'll be hitting 5 key areas. 1. Mastering conversion costs. 2. Decoding indirect overheads. 3. Classifying overhead functions. 4. The total cost of production. And 5. Cost accounting standards.
All right, kicking things off with Section 1, Mastering Conversion Costs. So, what exactly is a conversion cost? Simply put, it represents the heavy lifting. It's the total sum of direct wages, direct expenses, and overhead costs required to convert raw material into a finished product. Or, converting a material from one stage of production to the next. Basically, think of it as the cost of the process itself. It's everything required to actually transform those raw materials into something you can sell.
Now you've really got to notice how different authorities frame this exact same concept. The CMA official terminology defines conversion cost by what you add together, right? Direct labor, direct expense, and production overheads. But then you look at Cost Accounting Standard 1, and it defines it by what you leave out. It states that conversion cost is simply the production cost, excluding the cost of direct materials. If you see this on the exam, you must remember this contrast. It's literally 2 different ways of arriving at the exact same number.
Let's move on to Section 2, Decoding indirect overheads.
Okay, so according to CMA official terminology, an overhead cost is an expense that just isn't economically identifiable with a specific saleable cost unit. Basically, because you can't easily trace these costs directly to one single product, we call them indirect costs. They're common to several products or activities, and so they have to be apportioned. It's like trying to figure out exactly how much electricity went into making one specific pen out of a million. You just can't do it directly.
GAAP defines these indirect costs through a very specific triad. For the exam, remember that overheads are always comprised of indirect materials, indirect labor, and indirect expenses. For example, you can't trace the exact drops of machine lubricant to a specific widget, so that's your indirect material. A supervisor oversees the whole factory floor, so their salary is indirect labor. And factory rent? Well, that benefits the entire operation, making it an indirect expense.
That brings us to Section 3, Classifying Overhead Functions.
Once we know what overheads are, we have to assign them based on the purpose of the activity. We've got production overheads, which are involved in actual manufacturing, administrative overheads, covering general management, selling overheads, related to making the sale, and distribution overheads for delivery. Oh, and here's a key point. Marketing overheads? That's just an umbrella term. It's simply the sum of your selling and your distribution overheads combined. Now, a super common trap for students is confusing selling and distribution overheads. Selling is the logistics. Actually, scratch that. Let's get this right. Selling overheads are all about creating and stimulating demand before the sale even happens. Think advertisements and the sales team's salaries. Distribution overheads, on the other hand, are purely logistical. That's handling the product from the moment it's ready for dispatch until it physically reaches the consumer. In short, selling secures the order, distribution physically fulfills it. Okay, on to Section 4, Total Cost of Production. We don't just randomly dump a bunch of numbers into a calculator to find the cost of production. GAAP gives us a highly structured scaffold. Step 1, we start with our direct, traceable base costs. Step 2, we layer in our core overheads. And note this, that means production overheads and only the administrative overheads that directly relate to production. Step 3 adds specialized support costs like quality control, packing, and R&D. And finally, Step 4 makes our absolutely crucial stock adjustments. And here it is, the whole shebang altogether. This is the exact GCAP-compliant master equation that you need to commit to memory. Every single element here is required to arrive at the true cost of production for a product or service. But again, be careful. General administrative overheads that aren't related to production, or marketing and finance costs, they do not belong in this formula. Only administrative overheads directly relating to production get an invite to this party.
So, about those adjustments we mentioned. This phase right here is where so many people make mistakes. To arrive at the final cost of production, you must account for the opening and closing stock of your work in process and your finished goods. Plus, any recoveries you get from selling off scrap or from wastage, those have to be subtracted, which effectively reduces your overall cost burden.
All right, here's a highly testable fact regarding goods dispatched for what is called captive consumption. That just means goods manufactured by one division of a company and then consumed by another division of that exact same company. Under Rule 30 of the CGST rules, the assessable value for these internally transferred goods is exactly 110% of the cost of production. So you calculate the cost of production using the master formula we just covered, you make your adjustments, and then boom, you apply that 110% rule.
Finally, let's look at Section 5, Cost Accounting Standards. To prevent utter chaos and ensure everybody is speaking the exact same financial language, the Institute of Cost Accountants of India constituted the Cost Accounting Standards Board, or CASPI. Their main goal is to provide a structured approach to cost measurement, acting as a guide for user organizations, government bodies, regulators, and even academic institutions.
The absolute core mission of the board is achieving uniformity and consistency. Whether a company is allocating indirect materials or calculating conversion costs, the cost accounting standards are there to ensure that the classification, measurement, and assignment of costs to products and services are handled the exact same way across the board. No guesswork allowed.
So, how many definitive standards has the board actually issued? Well, as of the dates in your current syllabus, the Institute has released exactly 24 cost accounting standards. That's alongside the Generally Accepted Cost Accounting Principles, or GACAP, and 11 guidance notes. Knowing these numbers and being able to recognize foundational standards like CAS 1 is absolutely essential for your foundational knowledge.
We've covered a ton of vital ground in this explainer today, from the nuances of conversion costs to the rigid structure of that total cost of production formula. So, as we wrap this up and you head back to your exam prep, I want you to ask yourself, are you ready right now to confidently reconstruct these essential formulas from memory? Can you effortlessly separate a selling overhead from a distribution overhead, review these definitions, lock them down tight, and you'll be incredibly well prepared? Keep up the great studying, and I'll catch you in the next explainer.